Alright guys, welcome to the second indicator tutorial video. In the first one we discussed the momentum indicators such as RSI and MACD. In this one we'll discuss the most commonly used indicator with all technical analysts, that's the moving average. To get it on the chart, just go to the indicators and type up moving average. Now you can see there are a bunch of moving averages here. The most common ones is a simple moving average, that's just a moving average, and the moving average exponential, which is called the EMA. The difference between the two is the moving average weighs the impact of all the candles or all the price action equally, while the exponential moving average gives more importance to the recent price action and less to the one before that. Once I explain how the simple moving average works, you guys will have an idea of what I mean by giving importance to all the candles equally. So, a moving average is simply the average price of a given period of time in the past. So if you go to the settings here, currently the length is 9. AKA this moving average is tracking the average price of the action of the previous 9 days. Because we are on the daily time frame, so it's previous 9 days. So you can change that to whatever length you want. The most commonly used are 9, 20, 50 and 200. So we'll discuss them one by one. If you guys have seen the price action pro videos, I use moving averages quite a bit. And the way you use them is to assess what direction the price is moving in. It's called a trend indicator because it tells you if the market is trending. So let's look at an example. Here you have a constantly rising 9MA, and as long as this 9MA keeps rising and the price is above this, you have to assume that the price is in an uptrend. That's what it is used. It's a filter. So if the price is above the 9MA, it means price has short-term bullish momentum. If the price, once it drops below the 9MA, that means that momentum is lost. And once the 9MA starts to drop after flattening out, it means now price has negative momentum, right? So it's a negative trend. That's why it's called a trend indicator, because it keeps you in the trend as long as the trend is going. And then once the trend is over, it gets you out of it. So let's add a couple more. Let's see the common ones that people use. So I said 9, 20, 50 and 200. I will add 50 for now. All right, let's go. So the way, as I said, a moving average can be used to filter. Here the 9MA, as long as price is above it, it does have short-term bullish momentum. The trend is up. Once the price dropped below the 9MA, we can say the short-term bullish momentum is gone. 50MA is obviously tracking the price over the last 50 candles. So with the help of that, you can assess the momentum over a larger period of time, aka you can call it the medium-term momentum. So as long as price is above the 50MA, it has medium-term bullish momentum. And once it's below it, it has medium-term bearish momentum. The reason 50MA is used a lot is because most of the hedge funds, they work on larger time frames, they work on the weekly charts, and we have around 50 weeks in a trading year. So it gives them a good picture of how the market is moving with respect to the year. So if you guys will notice, large hedge funds use 50MA quite a bit. 50MA corresponds roughly to the 200-day moving average. So it's the 50MA on the weekly chart is around 200MA on the daily chart. And if you guys have read any financial news or listened to any technical analyst, you will hear them speak about the 200MA on the daily charts quite a bit. It's a very important line, and that's how they assess the market, if the market is bullish or bearish. So you can see here, as long as Apple was over the 50MA for the longest time, it just kept going up. While 50MA was flattening here and Apple was moving to the side, you can say it's just chopping. So the big boys, the hedge funds, they make decisions using the 50 MA. And this is another reason why you will see moving averages on the charts all around. One thing you can say is when price is quite extended from the moving averages, let's say 9 MA or 50 MA, you should expect some pullback. So in this case, for example, you have price kept going in a straight line up above this 9 MA, became quite extended from the 50 MA, and then we saw some form of pullback. And the same way here, you have price having short-term bullish momentum for a long time. Once it stalled and then price broke down, it pulled back to the 50 MA. So you will see over the long term, 50 MA ends up being a magnet for price to return to. Same way, it also ends up being a support. As I just mentioned, a lot of hedge funds use the 50 MA on weekly charts to put on the big positions. So you can see how many times you will have the 50 MA acting as a support and the stock just running above it. That's about it. There's not much more to mention about the moving averages. It simply gives you an idea of where price is going. What else can we say? What else can we discuss? Yes, this is one thing, and you guys might not realize it because it doesn't happen too often. But we discussed the importance of the 200 MA on the daily charts and how most technical analysts use it quite a bit. The 200 MA on the weekly charts is where the big boys decide if the bear market is going to get severe or not. The 200 MA on the weekly charts, below that nothing good happens. The big crashes like the ones we saw in 2008, the ones we saw in the tech bubble, all those happen. The major sell-offs happen below the 200-week moving average. So let's say you are a long-term investor with a large horizon, let's say 10 years or something. Once price, and even if you hold the short-term variations, once price starts closing below the 200-week moving averages on the major indices, you should have nothing in your portfolio. Like that's it. That's where the majority of the pain in a bear market comes. So that's just something I wanted to mention. It's quite important. And a lot of big traders have mentioned how the real pain of a bear market begins below a 200-week moving average. Alright guys, that's about it for moving averages. There's not much more to discuss. Obviously you will hear a lot of things that people come up with in order for their own system. But just keeping it simple, keeping the knowledge there, mentioning the most common ones, and then just play around with the different settings and see which one aligns with your strategy in order to keep you in a trend when it's moving in your favor and get you out of it when it's not. If you have any questions, ask them in the chat and I will be happy to respond.